They say the secret to wealth lies in the mind of a genius. Imagine waking up one day with the financial wisdom of Warren Buffett. What would you do differently? Would you invest in stocks, start a business, or maybe even build your own empire? Picture this: a man who turned $100 into billions, navigating the stormy seas of the market while others panicked. What if I told you that his success isn't just luck or insider knowledge? It's rooted in principles that anyone can adopt. Yes, even you. Now let's pause for a moment. Think about your financial goals. Are you tired of living paycheck to paycheck? Do you dream of financial freedom? With the right strategies, those dreams can become reality. Every great investor has their playbook. Buffett's is filled with insights that can transform your approach to money. Have you ever wondered why he's so successful? What are the secrets behind his legendary status? Stay with me as we uncover these 8 game-changing strategies. You might just find the blueprint you've been looking for. Ready to dive deep? Let's unlock the secrets to multiplying your money. Long-term investment. When I first dipped my toes into the world of investing, I quickly learned that the allure of quick profits could be both tempting and deceptive. It felt like a roller coaster ride, the kind where your heart races and your palms sweat. But at the end of the day, it's all about the thrill rather than the journey. I realized that investing for the long haul was the key to building real wealth. You see, time is one of the most powerful allies in the investment arena. The longer you hold onto your investments, the more chance you have for compounding returns to work their magic. It's easy to get caught up in the daily fluctuations of the market. One day, your stocks are soaring, and the next, they're plummeting. I remember feeling that rush of excitement when I made a quick trade that turned out to be profitable. But those moments were fleeting, and I soon understood that chasing after quick gains often leads to more losses than successes. By committing to a long-term investment strategy, I began to focus on the bigger picture. My mindset shifted from what's happening today to where will I be in 10 years? One of the most liberating aspects of long-term investing is the reduction of stress. Instead of constantly checking stock prices or worrying about the next market crash, I started to adopt a more patient approach. I began to trust my research and the fundamentals of the companies I invested in. The noise of the market began to fade away as I focused on the growth potential of my holdings. This change not only improved my investment outcomes, but also my overall mental well-being. Moreover, investing with a long-term perspective allows for the natural ebbs and flows of the market. I learned that downturns are part of the investment journey. Rather than panic selling during a market dip, I viewed these moments as opportunities to buy more of what I believed in. This mindset helped me to take advantage of lower prices and, in turn, positioned my portfolio for greater gains when the market rebounded. The key takeaway was simple: patience pays off. In the end, long-term investing is not just about the numbers. It's about developing a mindset that aligns with your financial goals. It requires discipline, understanding, and a willingness to ride out the waves of market volatility. The more I embraced this philosophy, the more confident I became in my investment choices. It's a journey that I'm grateful to be on, and I know that the fruits of my labor will be worth the wait. Understanding the business. One of the most valuable lessons I've learned in my investment journey is to invest in what I understand. It sounds simple, but it's astonishing how many people jump into investments without fully grasping the business behind them. Early on, I made the mistake of following trends and investing in companies just because everyone else was doing it. This approach led me to some frustrating losses, and I quickly realized that true success in investing comes from a deep understanding of the businesses I'm putting my money into. When I take the time to study a company, I want to know its products, its competitors, its market position, and its future prospects. Understanding the business also means looking at its financial health, things like revenue growth, profit margins, and debt levels. I remember spending hours poring over earnings reports and analyzing balance sheets, and although it felt tedious at times, that knowledge provided me with the confidence to make informed decisions. Moreover, knowing the sector in which a company operates is equally important. Different industries have unique dynamics, risks, and growth potentials. For instance, technology stocks might be volatile, but their long-term growth potential can be enormous if I understand the trends driving that sector. By honing in on sectors I'm familiar with, I can better assess the risks and rewards associated with an investment. This strategic focus has helped me avoid costly mistakes and seize opportunities that others might overlook. A solid understanding of the business also allows me to think critically about the company's future. I often ask myself questions like, what are the key drivers for growth? Are there any regulatory changes on the horizon that could impact its profitability? This analytical approach not only helps in identifying potential red flags, but also in recognizing opportunities before they become apparent to the market. In essence, investing in what I understand has transformed my investment approach. It has shifted my focus from following the crowd to making strategic, informed decisions that align with my financial goals. This understanding empowers me to take calculated risks and helps me stay grounded during market turbulence. It's a principle I carry with me in every investment I consider. Hesha, intrinsic value. Calculating intrinsic value has become one of my favorite aspects of investing. It's like being a detective, piecing together clues to uncover the real worth of a company. I've learned that the market sometimes misprices stocks, presenting opportunities to buy undervalued companies that others may overlook. The key is to develop a methodology for assessing intrinsic value, which involves understanding a company's future cash flows, growth rates, and risk factors. When I analyze intrinsic value, I often start with the company's earnings. I look at its historical performance and project future earnings based on realistic growth assumptions. This process involves estimating how much money the company is likely to generate and then discounting that future cash flow back to its present value. While it can be complex, it's essential for determining whether a stock is undervalued or overvalued. I've found that comparing a company's intrinsic value to its current market price provides valuable insights. If the intrinsic value is significantly higher than the market price, it might indicate a buying opportunity. However, it's crucial to conduct thorough research and ensure that my assumptions are based on solid data. I've learned the hard way that jumping into an investment just because it looks cheap can lead to disappointing results if the underlying business fundamentals are weak. Another aspect of calculating intrinsic value is understanding the concept of margin of safety. This principle, popularized by value investors like Benjamin Graham, suggests that I should only invest when there's a substantial gap between the intrinsic value and the market price. This cushion protects me from unforeseen events that could negatively impact the investment. It's a strategy that has served me well, as it encourages me to be patient and selective with my investments. Ultimately, the practice of calculating intrinsic value has deepened my understanding of the companies I invest in. It has shifted my focus from short-term price movements to the underlying fundamentals that drive long-term growth. By honing this skill, I've become more confident in my investment decisions and better equipped to identify opportunities that align with my financial goals. Intrinsic value is not just a number, it's a lens through which I view potential investments, helping me navigate the complexities of the market. Diversification. Controlled. When it comes to investing, I've always found that the old adage, "don't put all your eggs in one basket," has some truth to it. However, I've learned that diversification doesn't mean scattering my investments across every available option. Instead, it's about carefully selecting a limited number of assets that I genuinely understand. I've discovered that when I focus on a few investments that I know well, I can monitor them closely and make informed decisions. It's like having a few close friends instead of a huge social circle. You can invest your time and energy more effectively. I remember when I first started investing, I tried to diversify so much that I ended up with a portfolio that resembled a patchwork quilt. I had stocks from various industries, bonds, real estate investments, and even a cryptocurrency or two. The problem was that I didn't have a firm grasp on most of these assets. I was spread too thin, and when market fluctuations occurred, I found it challenging to keep track of everything. I learned the hard way that it's better to invest in sectors where I can leverage my knowledge and make sense of the market dynamics. The key to controlled diversification is to strike a balance. I've found that by focusing on 3 to 5 sectors or companies that I'm passionate about or have expertise in, I can create a well-rounded portfolio without overwhelming myself. This strategy allows me to allocate more time to research and understand the nuances of these investments. It's not just about the potential returns, it's about feeling confident in my choices and being able to articulate the reasons behind my decisions. Moreover, controlled diversification helps in managing risk. When I invest in a limited number of assets, I can better assess their performance and recognize patterns that might indicate potential issues. If I were to spread my investments too thin, I might overlook warning signs or fail to react quickly enough. By honing in on a select few, I can keep a close eye on market trends, news, and financial reports, allowing me to make more proactive investment decisions. Ultimately, controlled diversification has allowed me to build a portfolio that reflects my interests and expertise. I've come to appreciate that investing isn't just about numbers. It's also about understanding the story behind each asset. By focusing on what I know, I can navigate the complexities of the market with more confidence and clarity. It's a strategy that has served me well over time, and I believe it's a cornerstone of successful investing. Discipline and patience. Discipline and patience have become my best friends in the world of investing. I've learned that the market is unpredictable, and it can be all too easy to let emotions drive my decisions. I remember a time when I panicked during a market dip and sold off a significant portion of my portfolio. It felt like the right thing to do at the moment, but in hindsight, I realized that I had let fear dictate my actions. Since then, I've committed to maintaining my discipline and sticking to my investment strategy regardless of market fluctuations. One of the most valuable lessons I've learned is to have a clear plan in place before I dive into any investment. This plan serves as my anchor during turbulent times. I take the time to define my goals, risk tolerance, and investment timeline. By having a structured approach, I can remind myself of the reasons why I invested in a particular asset, even when external factors seem to suggest otherwise. This clarity helps me resist the temptation to make impulsive decisions, which can often lead to regret. Patience, on the other hand, is the cornerstone of long-term success in investing. I've come to appreciate that wealth accumulation doesn't happen overnight. Instead, it's a gradual process that requires time to bear fruit. I've seen many investors become frustrated when they don't see immediate returns and subsequently abandon their strategies. I remind myself that some of the best investments take years to realize their full potential, and it's crucial to stay the course and trust the process. I also find it helpful to maintain a long-term perspective. When I look at my investments, I try to envision where they could be in 5 or 10 years, rather than focusing solely on short-term fluctuations. This mindset has changed how I react to daily market movements. Instead of getting caught up in the noise, I can take a step back and evaluate whether my investments are still aligned with my overall strategy and goals. Moreover, I've learned to celebrate small victories along the way. While I remain patient for the larger returns, acknowledging the progress I've made keeps me motivated. Whether it's a dividend payment or a modest increase in stock value, every little win reinforces my commitment to my investment strategy. Discipline and patience are not just traits. They are essential components that have shaped my investing journey, allowing me to navigate the complexities of the market with a sense of purpose and resolve. Reinvestment of profits. The idea of reinvesting profits has been a game changer for me in terms of growing my wealth. Early in my investing journey, I often found myself pocketing dividends and gains, thinking I deserved a reward for my success. However, I soon realized that this approach was counterproductive. Instead of enjoying short-term gains, I've come to understand the power of reinvesting those profits to compound my returns over time. It's incredible how small amounts can snowball into significant wealth when given the chance to grow. When I first started reinvesting dividends, I was amazed at how quickly my portfolio began to expand. Each time I received a dividend payment, I would promptly reinvest it back into the same stock or into another asset within my portfolio. This strategy allowed me to purchase more shares without having to invest additional capital. Over time, I've witnessed how this compounding effect has accelerated my investment growth. It's like planting seeds in a garden. The more seeds I plant, the more blooms I can enjoy down the line. I've also learned that reinvesting gains isn't just about dividends. When I sell an asset for a profit, I make it a priority to reinvest those proceeds rather than letting them sit idle in a cash account. It's essential to keep my money working for me, and reinvesting allows me to take advantage of new opportunities as they arise. By being proactive with my gains, I can capitalize on market trends and position myself for future success. One of the benefits of this strategy is that it aligns with my long-term investment goals. I'm not just looking for quick wins. I want to build a robust portfolio that can withstand market fluctuations and ultimately provide me with financial security. By continuously reinvesting my profits, I'm creating a self-sustaining cycle that fuels my investment growth. It's a rewarding feeling to witness my portfolio expand as a result of my commitment to reinvestment. In essence, reinvesting profits has transformed how I view my investments. It's no longer just about making money. It's about strategically positioning myself for the future. I've learned to embrace the long game, appreciating that the choices I make today will significantly impact my financial landscape in the years to come. This mindset has empowered me to take control of my investing journey and has reinforced my belief in the potential of compound growth. Data, analysis, and patterns. As I sit here, staring at a sea of numbers and charts on my computer screen, I can't help but feel both exhilarated and overwhelmed. The world of investing is like a vast ocean, and I'm just a small boat navigating through its waves. The key to my journey: data analysis and patterns. Understanding financial data is not just a skill, it's a necessity. Relying on emotions can lead to disastrous decisions, but when I immerse myself in the data, I find clarity. I remember a time when I let my gut feelings guide my investments. It was a roller coaster ride, filled with highs and lows that left me dizzy. I bought stocks based on a hunch rather than solid data, and more often than not, I ended up regretting those impulsive decisions. That's when I realized that emotions are fickle. One day they can lead you to a brilliant idea, and the next they can send you spiraling down a path of losses. Now, I rely on historical data, financial reports, and market trends to make informed choices. The beauty of analyzing data is that it reveals patterns. When I look at a stock's performance over time, I can identify trends that may not be immediately apparent. For instance, I've learned to spot seasonal fluctuations in certain industries, which helps me anticipate potential price changes. Armed with this knowledge, I can make strategic decisions about when to buy or sell. It's like having a roadmap that guides me through the complexities of investing. Moreover, I've also come to appreciate the power of technology in data analysis. With the right tools, I can crunch numbers and generate insights that would have taken me hours, if not days, to uncover manually. I often use software that allows me to visualize data in various formats, making it easier to spot correlations and anomalies. This technological edge gives me the confidence to make decisions based on facts rather than fleeting emotions. In essence, data analysis and recognizing patterns have transformed my approach to investing. It's no longer about guesswork, it's about strategy and foresight. The more I delve into the numbers, the more I understand the market's behavior, and this understanding empowers me to make choices that align with my long-term financial goals. Risk management. When it comes to investing, one fundamental truth stands out. Risk is an inherent part of the game. However, what I've learned over the years is that managing risk is not about avoiding it altogether, but rather about identifying and mitigating it effectively. I remember my early days as an investor when I dived headfirst into opportunities without considering the potential downsides. That reckless abandon cost me dearly, and it was a lesson I won't soon forget. Today, I approach risk management with a calculated mindset. I start by assessing the risks associated with each investment. This involves looking at various factors, such as market volatility, industry trends, and even geopolitical events that could impact my assets. By understanding these risks, I can create a more robust investment strategy that accounts for potential pitfalls. For instance, I've learned to diversify my portfolio not just to increase potential returns, but as a means of spreading risk across different sectors. Another crucial aspect of risk management is setting clear boundaries. I have established rules for myself regarding how much of my capital I'm willing to risk on any single investment. This discipline prevents me from making impulsive decisions driven by greed or fear. Having a predetermined risk tolerance allows me to stay focused on my long-term goals rather than getting swept up in the emotional turmoil of the market. Moreover, I've found that regularly reviewing my investments is essential for effective risk management. The market is constantly changing, and so are the circumstances surrounding my investments. By conducting periodic assessments, I can identify any emerging risks and adjust my strategy accordingly. This proactive approach has saved me from potential losses and kept my portfolio aligned with my financial objectives. In conclusion, risk management is not merely a safety net, it's an integral part of my investment philosophy. By recognizing, assessing, and mitigating risks, I can navigate the turbulent waters of investing with greater confidence. It's about staying grounded, making informed choices, and ultimately preserving my capital while striving for growth. And there you have it, Warren Buffett's 8 powerful secrets for multiplying your money. Each principle is a stepping stone on your path to financial freedom, but remember, knowledge is only half the battle. The real magic happens when you take action. So, which of these secrets resonates with you the most? Are you ready to implement them in your daily life? But wait, let's not stop here. Imagine what your financial future could look like if you started applying just one of these strategies today. Picture yourself making informed investments, growing your wealth, and securing a brighter tomorrow. How would that change your life? If you found value in these insights, don't forget to hit that like button and share your thoughts in the comments below. What are your personal financial goals? Let's inspire each other. And if you want to dive deeper into the world of investing and wealth building strategies, stick around for our next video. Trust me, you won't want to miss it. Remember, every day is a new chance to grow your financial knowledge. So get out there, start investing in yourself, and let's make those dreams a reality.